Guys, the Trump tariff news is out and the stock market is not liking it. The Dow Futures are down about 1,000 points. NASDAQ Futures are down about 4%. These are really big moves. I don't think we've seen a daily move like this probably since the pandemic started. So is this just a knee-jerk reaction and the market's going to come back up, or is this a continuation of a long decline in an overpriced stock market? So I'm going to look at this tariff news and look at the specific tariffs that some countries have on the US and what we propose to charge them. And then I'm going to look at the valuation of the stock market using a few different metrics. Spoiler alert, we are still overpriced by most metrics. So let's get into it. So Zero Hedge has the news, futures tumble as Trump delivers declaration of economic independence. And so he has these charts showing what other countries charge us and what we're going to charge them. So some of our biggest trading partners like China, the EU, and Japan charge us 67%, 39%, 46%. So he is proposing that he's going to charge about half of what they charge us. But Mexico and Canada are not on that list, as US will continue to exempt USMCA compliant goods. And some goods will not be subject to reciprocal tariffs. And for all you gold and silver bugs, bullion, which is good, and energy and other certain minerals that are not available in the US. Initially, the futures climbed on that news, and then they jumped out the window and went from about 57.50 on the S&P futures down to 55.84. Trump said, if you want your tariff rate to be zero, then build your product right here in America, because there is no tariff if you build your product in America. Likewise to all foreign presidents, prime minister, kings, queens, etc., everyone else who will soon be calling to ask for exemptions from these tariffs, I say terminate your own tariffs, drop your barriers, and don't manipulate your currencies. Now, this is subjective because everybody manipulates their currencies if they have a central bank that raises and lowers interest rates and all of that like we do and like almost every country on earth does. Now, if you watch the media that is against the tariffs, they say it's unfair and all this stuff. What's unfair is if you look at the tariffs that other countries have been charging us for so many years. So the dark blue is the tariff rate, the light blue is the non-tariff barriers. And non-tariff barriers include regulations, rules of origin, and quotas. Basically, all kinds of ways to get around not letting our products in, but not actually calling it a tariff. And so our tariffs are like, 3%, where countries like Argentina, South Korea are at least 13% or so. And if you add the non-tariff barriers, they could be as high as 25%. Now, how true are these non-tariff barriers? I don't know, that's subjective. You could say part of it is manipulation of currencies or making certain rules that make it almost impossible for us to get our fruit or foods in or something like that. There's all kinds of ways about it that they don't say we're tariffing your goods, but your goods are not allowed in here or something along those lines. So a lot of this is possibly subjective, but you cannot argue these actual tariff rates here. So this knee-jerk reaction in the stock market is because of the headline of the tariffs, but there could be underlying things in the stock market as well. When the market is weak and going to head down, good news sells the market off a little or doesn't go up that much. Bad news is a catastrophe for the market. And you've seen this before during the internet bubble and the great financial crisis. When things started heading down, even good news did not make the market go up. As a matter of fact, made the market go even lower in some cases. I remember during the internet bubble when the market already started crashing pretty big, and Yahoo was a bellwether at that time. It was the Google before Google, so their earnings mattered. They came out with earnings right when the market was crashing, and so they had good earnings, and it didn't matter. Not only did the stock not go up, it just tanked a lot more, and that was kind of the signal for everybody that kind of the party is over and sell now kind of mentality. And so history doesn't repeat, but it rhymes. And during the internet gold rush and the internet bubble, all these telecom companies, Global Crossing and all these guys were building out a whole bunch of fiber optic cables all over the country because they thought that there was just going to be unlimited growth in the internet. And of course there was, but they built it out so much. Why? Because they wanted to be the first person to get there, and they didn't want any competitors to have more fiber available than them. So they just built at any cost. They didn't care that they didn't have the customers to fill the fiber, and they were able to get financing from the equipment manufacturers like Lucent and Nortel and all this stuff. So it was a huge race to put as much fiber in the ground, no matter what the cost, no matter how much debt you have to take on, no matter how long it's going to take you to finally fill up that fiber with actual paying traffic. It didn't matter. And that's kind of what we're seeing right now with these AI data center build-outs. So the big guys like Microsoft, Amazon, Meta, Google, they don't really care that they're spending all this money and it may not make them money for a long time, because in their mind, if they are slow or prudent, the person who builds more and gets there before them is going to be the one that takes the lion's share of all the AI riches. So they are just building like crazy and throwing all this money at it, hoping that it's going to matter in the end. So it looks like Microsoft is already cutting back on the build out of some of these data centers, and that's making people think twice. And so maybe the bubble has already popped on the AI mania, and people are slowly waking up one by one. And when they wake up, they will start selling. So we may be at the stage that people are just now, a few are starting to recover their senses and thinking, why am I overpaying for these stocks based on all kinds of valuations that say that this market is very expensive? And let's look at some of those valuations. So this is the Case Shiller cyclically adjusted price to earnings ratio. In the gray, that's the CAPE ratio, and when it gets above 22, the market is overpriced. In red, this is the total return of the S&P 500 index, and you see when it gets above 22, like around this level, here, and where we are here, the next 10 years or so of the stock market are very bad, right? They do almost nothing. They go sideways here, and now here. And if you don't know, after the internet bubble, it took around 15 years for the stock market to reach the old highs from the early 2000s, right? So a quick look at the chart of the SPY, the S&P 500. At its peak in 2000, it was about 151, same peak around 2007, and it didn't retake that number until 2012, 2013 or something. So at least 10, 12 years before it recovered the 2000 bubble peak. Of course, the NASDAQ QQQ is even worse, right? The peak here in 2000 at about 123 was not recovered till about 2016. So a good way to visualize this is CAPE versus real returns of the following 15 years per annum. All equity markets in blue: Japan, Germany, US, right? So the higher the CAPE, cyclically adjusted price to earnings, the lower the next 15 years annual return you're going to get. So if you're at 70, right, like Japan was, the next 15 years they did minus 6% per year. We're here around 35 right now, right? So looking at this, the R squared line of the average of all of this, you can expect that if you're at 35, you're going to be making about 0% a year for the next 15 years. That doesn't mean that's what the return is going to be every year. It could be down 10% one year, down 7% another year, down 6%, then down 2%, then up 5% and all that. But your average return per year for the 15 years is about 0. Now, when the CAPE is around 10, your return for the next 15 years is like maybe 13% or so. And the lower it is, the higher your return for the next 15 years. And the Warren Buffett indicator, which he uses to see how overpriced the stock market is take the value of all the stocks in the US stock market and divide it by the yearly GDP. And you see the average is less than about 100%. It's what, like 80% or so? During the internet bubble, we got up to 138%, financial crisis 105%. Here, we got up to over 200%, and now we're at what, 189%? So we are more than 100% too expensive based on the historical stock market to GDP ratio, which Buffett uses. And so this is probably the main reason why Warren Buffett is about 30% in cash in Berkshire Hathaway, and he's not even buying back any stock with that cash because even Berkshire Hathaway is too expensive for his tastes. So on a valuation level, the stock market is still very expensive with like a 35 CAPE. Looking at the charts, this is a monthly chart, and this is the 50-month moving average. This is the pandemic when we briefly went under that, and this is the late 2021 drop, and it barely touched under that. But look how extended we are from the 50-month moving average. I mean, just to touch it, we'd be back to 470. So that would be about a 20% drop, not including the after hours drop that we just saw on the Trump tariffs. So there's a lot of air between here and here. And on a shorter term time frame, a daily chart, this is the 200-day moving average, where a lot of investors live and die by the 200-day moving average. If it's below the 200-day moving average, we are heading lower. If we get above, that's positive. Well, we dropped below the 200-day moving average very fast, one of the fastest drops in a very long time. And this recovery to the 200-day moving average was so wimpy, it barely got above and came right back down and tested this level again, right? And now we had this little bounce today, and this after hours move is going to blast us right down through this. So this is not a positive technical setup at all. It's looking like we made the drop below. It didn't bounce off the 200-day at all. It just went right through, made this wimpy bounce, couldn't even get one candle above the 200-day moving average, and came right back down and tested this low. We have this little bounce, and now it looks like we're ready to blast right through that. So I don't know what's going to happen with these tariffs. What percentage of Trump's tariffs is really a negotiating tactic? Probably a good portion of it. But there are some real issues with the tariffs that other countries charge us, and we charge them such a low rate. But I don't think the tariff news is 100% the reason why the stock market is selling off, especially in the last couple of weeks or whatever. I think a lot of it has to do with how overpriced we are, and people are starting to realize that and maybe taking some chips off the table, waiting for valuations to get cheaper. So guys, it looks like stocks are still way too expensive. If we just go back to historical PE levels of like 15 PE, that's a 50% reduction in the S&P 500. And when the stock market goes down, it usually overshoots to the downside as well as when it overshoots to the upside during peak euphoria. So trees don't grow to the sky, and the overvaluation of the stock market eventually reverses to the mean. When that happens is anybody's guess, but it looks like there are a lot of cracks starting to show in the stock market. What do you think? Thanks for watching, guys.